IAS 11, also known as International Accounting Standard 11, is a crucial guideline for accounting in construction contracts. It ensures revenue and costs reflect the real financial performance of construction projects. This is important as projects often span multiple accounting periods. IAS 11 ensures financial statements reflect accurate economic realities. It aligns revenue recognition with actual project progress. This provides a more accurate picture of a company's financial health. Understanding IAS 11 requires familiarity with several key terms. A construction contract is an agreement to construct an asset or a combination of assets. This includes buildings, roads, bridges, and other infrastructure projects. These contracts can be either fixed price or cost plus. A fixed price contract is one where the contractor agrees to a fixed contract price. This price may be subject to variations based on changes in the contract work. The contractor bears the risk of cost overruns in this type of contract. This makes cost estimation crucial for profitability. A cost-plus contract, on the other hand, involves the contractor being reimbursed for allowable or defined costs. In addition, the contractor earns an agreed-upon profit margin. This type of contract shifts more risk onto the client as they bear the risk of cost overruns. These definitions are fundamental for applying IAS 11 effectively. They help in determining how to recognize revenue and costs, and how to manage financial reporting for construction projects. The percentage of completion method is a key concept under IAS 11 for recognizing revenue and costs. This method aligns revenue recognition with the progress of the construction project. Companies estimate total contract costs and determine the proportion of work completed. Revenue and expenses are recognized in proportion to the percentage of completion. For example, if a project is 40% complete, then 40% of the contract revenue and costs are recognized. This method provides a more accurate reflection of financial performance. The completed contract method is another approach for recognizing revenue and costs in construction contracts. Under this method, revenue and expenses are not recognized until the contract is completed. This means that all costs and revenue are deferred until the end of the project. While this method may seem straightforward, it has significant limitations under IAS 11. It can result in financial statements that do not reflect the current financial performance of a company. This is because no revenue or profit is recognized until the project is finished, which could be several years after the project starts. Using the completed contract method can lead to significant fluctuations in financial results. This is often referred to as earnings volatility. For companies with multiple ongoing projects, this method can make it difficult to assess their true financial health. Despite its limitations, the completed contract method might be used in certain circumstances. However, IAS 11 generally encourages the use of the percentage of completion method to provide a more accurate reflection of ongoing financial performance. Section 5. Types of costs in construction contracts. Identifying costs in construction contracts is essential for accurate financial reporting. Costs are categorized into direct, indirect, and other costs. Direct costs include materials, labor, and subcontractors. Indirect costs cover site supervision and administrative expenses. Proper allocation ensures accurate financial statements. This aids in better financial decision-making and reporting. Section 6. Recognizing expected losses. IAS 11 also provides guidance on recognizing expected losses in construction contracts. This is crucial because construction projects are often subject to risks and uncertainties that can lead to cost overruns and losses. An expected loss on a construction contract should be recognized immediately when it is probable that total contract costs will exceed total contract revenue. This loss is recognized as an expense in the financial statements. This approach ensures that the financial statements reflect the economic realities of the project. Recognizing expected losses involves a detailed analysis of the project's progress and cost estimates. This requires regular monitoring and reassessment of project costs and revenues. If there is a significant change in the cost estimates, the recognized loss should be updated accordingly. By promptly recognizing expected losses, companies can provide a more accurate and transparent view of their financial health. This practice helps in managing risks and making informed financial decisions. Section 7. Disclosure requirements. Disclosure requirements under IAS 11 are designed to provide detailed information about construction contracts in the financial statements. These disclosures ensure transparency and allow users of financial statements to understand the financial impact of construction projects. Key disclosures include the amount of contract revenue recognized during the period, the methods used to determine the contract revenue, and the methods used to determine the stage of completion. These disclosures give insights into how revenue and costs are recognized and provide a basis for assessing the reliability of the financial statements. Companies must also disclose the aggregate amount of costs incurred and recognized profits, less recognized losses to date. Additionally, they should report the amount of advances received and the amount of retentions from progress billings. These disclosures help users of financial statements to evaluate the financial performance of construction projects. They provide a comprehensive view of the revenue, costs, and profitability of construction contracts. Section 8. Example calculation. Consider a construction project with a total contract value of $1 million. Estimated total cost is $800,000. Costs incurred to date are $400,000 and the project is 50% complete. Completion percentage is 50%. Revenue recognized is $500,000. Costs recognized are $400,000. Profit recognized is $100,000. This aligns revenue recognition with project progress. Section 9. Comparison with IFRS 15. IAS 11 has been largely replaced by IFRS 15, revenue from contracts with customers. However, understanding the differences between these two standards is important. IFRS 15 introduces a 5-step model for revenue recognition, focusing on the identification of performance obligations and the timing of revenue recognition. Under IFRS 15, revenue is recognized when a performance obligation is satisfied, which can be over time or at a point in time. This differs from IAS 11, which primarily uses the percentage of completion method. IFRS 15 requires a more detailed analysis of contract terms and performance obligations. The transition from IAS 11 to IFRS 15 aims to provide a more comprehensive and consistent approach to revenue recognition across industries. However, the fundamental principles of recognizing revenue based on progress and matching costs remain relevant. Understanding these differences helps companies in transitioning to IFRS 15 and ensures compliance with the latest accounting standards. It also aids in better financial reporting and decision-making. Section 10. Importance of IAS 11. Despite the transition to IFRS 15, the importance of IAS 11 cannot be overlooked. For many companies, construction contracts signed before the adoption of IFRS 15 still require accounting under IAS 11. Moreover, understanding IAS 11 provides historical context for financial reporting practices in the construction industry. IAS 11 has laid the foundation for recognizing revenue and costs in long-term contracts. The principles of aligning revenue recognition with project progress and matching costs accurately are still relevant. These principles ensure that the financial statements reflect the true economic performance of construction projects. Moreover, for companies operating in jurisdictions that have not yet adopted IFRS 15, IAS 11 remains a critical standard. Mastering IAS 11 is essential for accurate financial reporting and compliance with accounting regulations. Understanding IAS 11 also helps in appreciating the advancements in accounting standards brought by IFRS 15. It provides a basis for comparing historical financial performance with current practices. Section 11, sir. Conclusion. In conclusion, mastering IAS 11 is essential for anyone involved in construction contract accounting. This standard provides the necessary framework for recognizing revenue and costs accurately. It ensures that financial statements reflect the true financial performance of construction projects. Key concepts such as the percentage of completion method and the recognition of expected losses are fundamental to accurate financial reporting. Understanding the types of costs and disclosure requirements further aids in providing transparency and reliability in financial statements. While IFRS 15 has replaced IAS 11, the principles of revenue recognition and cost matching remain relevant. Understanding IAS 11 provides historical context and ensures compliance with existing contracts. It also aids in transitioning to the new standards introduced by IFRS 15. Ultimately, mastering IAS 11 equips professionals with the knowledge to handle construction contract accounting effectively. It ensures that financial statements are accurate, reliable, and provide a true reflection of a company's financial health.